On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you again for joining us. Recession fears triggering a major market sell-off with the Nasdaq officially in correction territory. Now, this comes after signs showing weakness in the U.S. economy. A disappointing July jobs report showed that the U.S. economy added only 114,000 positions, falling way short of the 175,000 jobs expected and marking one of the weakest job growth rates since the pandemic. The unemployment rate also rising to 4.3%, the highest it's been in nearly 3 years, sparking those recession fears. And the ISM Manufacturing Index also dropped to an 8-month low. Now, there are concerns that the Federal Reserve may have waited too long to cut rates after holding steady at the last meeting, keeping rates at the highest level in over 2 decades. And this comes as the U.S. has reached a historic milestone, with the national debt now surpassing $35 trillion for the first time. Now, to put this number into perspective, the national debt was around $907 billion just 4 decades ago. Well, my next guest says that no matter what, all roads lead to more printing and more liquidity, which is ultimately bullish for gold and for Bitcoin. Here to guide us through all of this and give us his latest macro outlook is James Lavish. James is a managing partner of the Bitcoin Opportunity Fund, which is a hybrid investment fund that makes public and private investments in the Bitcoin ecosystem. And James is also the author of one of my favorite newsletters, the Informationist Newsletter, which I look forward to every weekend. James, great to have you back with us.
Always good to be here, Michelle. Thank you for having me.
All right, great. And we love having you on because you are really so excellent at breaking down very, very complex topics in digestible, easy to understand ways. So help us get a broad understanding of what we saw today with this big sell-off in the U.S. equity markets across the board, stocks falling, the Nasdaq officially entering correction territory, meaning it's below 10% from its highs. The S&P recovered a bit, but closing down 1.8%. The Dow Jones Industrial Average down 1.5%, pretty much red across the board. And you kind of got the sense that the markets are starting to understand that maybe bad news is bad news and that we could be in the verge of a recession. Well, what say you? What was behind this market reaction?
It was quite a week so far, right? So we have seen the Nasdaq. It has topped out for now, and we're seeing it back off from those highs because, I mean, let's admit it, we've had a tremendous run from the AI injection of excitement and enthusiasm in the space. So that was natural. But now what we're seeing is we're getting some indicators that are not that great out of the economy. Earlier this week, we had the Fed speak. We had Powell get up there and indicate that they're not quite ready to cut rates yet. Obviously, they would have cut here in July if they were ready, but they weren't. And so, but he did say, well, we could see a rate cut in September is basically the messaging he gave, but it wasn't strong enough to give the economy, to give the markets enough confidence in that the economy is going to stick it through while the Fed sticks that landing, which is the soft landing that they keep talking about, that ever so elusive soft landing. But we're seeing some difficult numbers coming out of the economy, and we got one today that actually is technically it's shown to trigger to show that the recession has already been triggered, and it's called the Sahm rule, and it just is an average of the last 3 unemployment readings and how much it's above that ultimate low, and so the low from last year, and it's up over 0.5. If it's over 0.5, that's technically in a recession area. We can get into a debate about how many decimal points you're supposed to go out when you calculate these things. But if you just look at this chart right here, you can see that every single time in the last however many recessions we've had, once it hits over 0.5, we're already in a recession. And so that has the market a little bit spooked today.
Right. And the Sahm rule, that is the rule devised by Fed
Sahm,
economist Claudia Sahm, closely tracked because, as you quite rightly say, it's worked in the past with the unemployment rate reaching 4.3% in July. The 3-month moving average of the unemployment rate is now at least 1.5 percentage point above the minimum of the 3-month averages from the previous 12-month. And then the rule states that reaching that 0.5% level means that there's a recession. However, Sahm herself told Bloomberg earlier this week that she doesn't actually think that the economy is in a recession, even though her rule is indicating it. She's not fully convinced that we're there yet because we've had such dramatic changes in the labor supply after the pandemic and the responses there. And the recent jump in immigration, legal or otherwise, has also diminished its usefulness, according to her. That said, she is still worried about the direction of the U.S. economy. And she is one of many that have said that the Fed has just waited too long to cut rates. Do you agree?
Well, I mean, it's a good point about immigration, illegal or not, the influx of 10 million plus people into this country.
And a whole bunch of other consequences that go with that on the political side.
A lot.
But, yeah.
Not to mention the spending that occurs because of it. We've had massive deficits, which we'll talk about in a minute. But one of the hallmarks of mistakes in Wall Street is that statement, "It's different this time," and so we just have to be really careful about that. Does history repeat itself? Well, I mean, we've seen how strong this indicator is. It's not something to be brushed off or ignored. It's something to very much have your attention on, and to know that once the economy starts down this road and we do start losing these jobs in earnest, it's a very difficult momentum to try to stop. And so we're talking about a Fed here that raised rates at a meteoric pace, and now they've been holding them high in relation to where they've been over the last 20 years. And we're in a situation now that the Fed is they're up against the wall, and they could run into a policy error here if they don't start thinking about lowering rates soon and at least giving the market that nod. The market gave the clear indication today that they're ready for a rate cut. And if you look at the Fed funds rate and where the probabilities of the cut, I can share my screen here and you could see this, but the probability of a rate cut now is over. It's basically 100% for the next meeting, which is in September, and they're expecting not just 100% cut there, but they're expecting another cut on top of it. So almost an 80% chance of another cut, which means 50 basis points in this next meeting. So they're really pushing the Fed here to say, we expect a cut. Yeah. And so that's what the market's telling them. Now, whether or not they're right, this is the question. Should they cut in September? Absolutely. At this point, it looks like they should be cutting in September. The question is, should it be 25 basis points or 50 basis points? And that gets me to the point of, well, maybe if we keep getting some difficult economic indicators here, some that they're showing that the economy is not that rosy, you could see an interim meeting rate cut. We've seen that plenty of times before in the past. And we've got an election year. There's a lot of political pressure. I could see that happen. The likelihood of that, I mean, I would say it's less than 50%, but it's way higher than 0%.
An interim meeting rate cut, I mean, they usually don't have one in August. You mean having an August meeting between now and September and saying we're going to cut?
Well, I think it would just be they wouldn't call an emergency meeting. They would just announce a cut and say we're ready. And so,
or like telegraph that because that could signal, a whole other message and perhaps create panic. If the Fed pivots that dramatically and signals that, wouldn't that create a whole different level of panic? Or do you think that the market then responds favorably to that?
As of today, with the data we have, I think that you're right. It would create more of big concern. It might have negative effects on the market. But if we start getting more negative, if we keep getting negative indicators and we see inflation come down even more sharply, we see the jobs numbers come down even more sharply, it could be warranted, and that could calm the market, because you can see the market's starting to get restless, and they're indicating that they're ready.
I will say this. It's tough to be Jerome Powell these days. He's taking a lot of heat, a lot of criticism, of course, of people calling him out, from Bond King Jeffrey Goodluck to Senator Elizabeth Warren saying that the Fed is too late, they should have cut. We had a colorful post from Senator Warren on X, and she said Fed Chair Powell made a serious mistake not cutting interest rates. He's been warned over and over again that waiting too long risks driving the economy into a ditch. And then she says the jobs data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. So sounds like Senator Warren is saying that intermediate rate cut should be happening. But again, I don't know if that creates more chaos.
Yeah, the Fed is not supposed to be political, but they do get tremendous pressure from the executive office and from certain politicians, for sure. The question is, look, the Fed's got two mandates, and in the last meeting, in the press conference, Powell made it clear that he's getting more comfortable with the inflation readings, which it's headed in the right direction. And inflation's going to continue to come down. It's kind of stuck at 3%, but that's mostly due to the massive fiscal spending that we have coming out of the government right now. And so that fiscal dominance is affecting his ability to pull that lever and actually hold inflation down or make it come down even more further. So the question is, as it's coming down, does it push through that 2% number, which would be really bad? That would be extremely negative for the Treasury. And so you will see pressure coming out of the White House, coming out of the executive branch and out of Congress, saying, hey, look, we don't want to have a recession as we head into this election. We want to have our soft landing. And so the question is, how much energy does it take from the Fed and other levers that they can pull to stop this train, because once it starts going in direction, it's kind of like an ocean liner. And once it's headed in this certain direction, how much energy does it take to stop it and turn it back around? And so the unemployment numbers is important here, because you could see on that chart that once it starts gravitating upwards, that's almost like liftoff. And then once it hits that spot, if you look at this chart, you can see that as soon as it ticks up above that 0.5 level, you can see unemployment just really accelerates upwards. Mm-hmm. Every single recession. So that's what we're looking at, and that's what the Fed is going to be keyed in on here. So he's going to be really, really keyed in on the employment numbers now, which is what he said he's going to kind of turn his attention to, and it makes sense. So I feel like today's this unemployment reading today was pretty significant. The question is, was it just an anomaly? Is it going to come back down for the next reading? Or is it going to accelerate upwards or stay where it is or accelerate upwards? That's the real question.
Right. And, you're getting this on the back of news from giants like Intel saying they're going to have to cut 15% of their workforce. It's becoming a very real phenomenon when you've got these arguably barometers of the economy, as Intel is on some level, saying they have to cut 15% of their workforce. Now, James, sure, the Fed has to deal with the U.S. economy, but there have been some factors outside of the Fed's control that have had a big impact here, and that is other central banks, particularly the Bank of Japan. The Bank of Japan recently raised interest rates to boost the yen's value, as the country there also struggling with inflation. The Bank of Japan raising rates from a range of 0 to 0.1 to a benchmark of 0.25, so to 25 basis points. That's huge. From 1 basis point to 25 basis points, that's a big jump. And that decision was surprising because Japanese officials typically stray away from such hawkish actions. And the bank, in fact, raised interest rates for the first time ever, in 17 years, just back in March, ending its negative interest rate policy. Because you are so exceptional at breaking down concepts like this, help our viewers understand why what is happening in Japan and the Bank of Japan is such a big problem for the US and the US economy.
Well, it's a big problem for global assets, right? So here's what's been going on. You've had extraordinarily low borrowing costs in Japan for over a decade, like since 2009. And so, and a bulk of that, they've had negative rates. So why does that matter? Well, the issue here is that as we were coming out of the pandemic, and we had all of these central banks that were raising their rates, right? So you had the EU and the US and Canada and Australia. Everybody was raising rates while Japan was actually actively holding their rates down to make sure that they could induce inflation. Remember, Japan came off a massive housing bubble pop decades ago, and they entered this period of super low inflation. And so they've been trying to drive that, and it's been difficult. So what they've had to do is monetize massive amounts of debt. So why does this matter? This matters because if you have very low interest rates in Japan, and you're an investor, you're a trader, what you can do is you can sell short Japanese bonds. And then for that, you're going to receive yen. And you're going to take those yen and you can sell them for another currency. You can sell them and buy dollars. And you can turn around and take those dollars and buy the higher yielding treasuries of the US. So you can see that the yen is the escape valve for this pressure, this monetary manipulation by Japanese, right? By the Bank of Japan. And so the yen becomes weaker and weaker and weaker. And we've been watching that over the last number of years. However, what happens is as those investors are borrowing that money, they're buying assets around the world, not just bonds for a higher yield, but they're able to borrow, they're able to borrow from the Bank of Japan for basically free and then turn around and buy risk assets around the world. And so as that trade now becomes unwound because of that negative, that carry trade gets unwound, well, now you're seeing risk assets get unwound along with it because they've got to go pay off that loan before it becomes, it gets upside down on them. So that's essentially what's happening there.
Right. I want to reference a post on X from one of our regular guests on the show, Ram Nunera, the founder of Crypto Banter. I'm going to get to the gist of the post, the condensed version, but he basically says that for the first time in many years, the Bank of Japan increased interest rates this week by 25 basis points, almost unprecedented. And as a result of the increased interest rates and the signal to the market, investors are now concerned that the money they borrowed for free is no longer free, and therefore they're unwinding their trades and sending the funds back to Japan. The estimated quantum of this trade is over $4 trillion. I don't know if that amount is accurate, but he's saying $4 trillion, and he says the only question that remains is how aggressive they will be. But for now, you must keep your eyes on this chart, referring to the US dollar yen chart. If it keeps strengthening, risk assets are going to get murdered.
Yeah, and we can see the chart. We can see the chart here, that the yen chart, and the I guess I have to change it, right? So sorry. We can see that the yen here it's been collapsing it's been collapsing against the dollar, which means that the yen's getting stronger. So remember, the yen is quoted in dollars. So this is the number of yen in dollars. So as that comes down, that means that the yen is getting stronger, and those trades are going against those traders, right? So that's the issue here, and they're having to unwind that, which means they have to unwind some of their risk assets, and that has absolutely been a factor today, and it's been a factor across the world. I mean, you also saw the Nikkei down the most in one day. It was down just about 6% today, which is the most it's been down since 1987, and that's because of this. It becomes that much more expensive to buy yen and buy those risk assets there.
All right, so given we've got the Bank of Japan and the consequences of what their interest rate means in terms of unwinding all of these assets, and as we've just discussed, the impact that it has on a bunch of assets globally, the situation in the US with rates at 2-decade highs, with the unemployment now starting to buckle under that, what is your outlook for, and we'll begin with the equity markets, like what do you see happening here now?
Well, I mean, this is the question of the ages, right? So we've been watching and waiting to see if these risk assets turn over. The answer, I think, is, look, I believe that we are grinding slower here and that the Fed is going to have to act. As much as I hate to admit it, the Fed is going to have to, they have an impact to the market here. And what they say and how they message what their stance is going to matter. I do believe that we come into a period here where the Fed actually doesn't mind having risk assets sell off a little bit. I think it helps them. It helps them because it will help that inflation side of the equation. Remember, the U.S. economy, the U.S. stock market is a massive amount of the U.S. economy now. So if that sells off a little bit, that helps them on the inflation side. It gets them in the 2% range, and then they can turn around and they can deliver those rate cuts without having too much carnage in the economy. That's what we're waiting for. So I do believe that we have some room to go here on the downside in risk assets. Now, if we do have a sharp sell-off, here's the caveat. It's going to be very difficult, in my opinion, to time this trade. And it'll look much like the March 2020 situation in April, when the Fed just turned around and almost immediately injected liquidity into the markets. Why would they do that? No, they would do that because there's a possible dysfunction in the credit markets. If you see dysfunction in the credit markets, which is what drives everything, Michelle, then that's when they're going to step in, because they cannot have dysfunction in the Treasury market. We are going back to what we were talking about earlier in the conversation, which is the massive deficits that we're running right now in arguably peacetime here. We're always running in wars and overseas, but we don't have technically, we may have just entered a recession, but we're not in a massive recession right now, yet we're running $2 trillion deficits. It's madness. So when we're running deficits that are 7% of GDP at a time that we're not even in a full-blown recession, it's complete madness. So what happens when we get into a recession? The costs, the mandatory expenses all blow up higher. So you could have mandatory expenses go up by 10, 20%. And we're already at $4.1 trillion there. So if you're up 20% there, you're looking at $5 trillion of mandatory expenses. And then your tax receipts are going to go down by 10 to 15%. So your tax receipts off of your $4.9 trillion of tax receipts, that could be down another $500 billion or $1 trillion. And so now we're talking about running $3.5–4 trillion deficits, maybe even more, so that the percent to GDP jumps over 10%. And this is where you're just going to have the Treasury and the Fed team up, enter the market, and start buying bonds again. There's just absolutely no way around it. They're going to have to enter the market if we do have a sharp downturn. There's no way. There's no way out. That's where we are.
You know, James, you mentioned that we have this tremendous deficit when we're not at war. Technically,
we are at war, but we're in proxy war. We're in a proxy war.
And that may have been a factor here as well, because
proxy wars. Sorry.
Investors may have taken some risk off the table given the very volatile geopolitical climate. I mean, obviously lots of upheaval in the US and such with the elections. But this weekend even perhaps could be very volatile, especially with escalation in the Middle East looking likely. Iran expecting to attack Israel to avenge assassinations of Hamas and Hezbollah terrorist leaders. And the White House said that they have a new defensive military deployment in the area to help Israel defend itself against Iran and its terrorist proxies, Hamas and Hezbollah. We've had a lot of heightened tensions between Hezbollah and Israel with back and forth airstrikes. And then, of course, that we know a top Hamas leader was killed in Tehran. Ismail Haniyeh reportedly killed by a bomb smuggled several months earlier into the guest house where he was staying. Now, Israel hasn't confirmed that it was behind this, but all arrows point there. And Israel did vow to kill Haniyeh and other leaders of Hamas after the Gaza terror group's devastating October 7th attack. So expect that Iran will retaliate. It's vowed to retaliate. It's vowed to annihilate Israel off the map. And you've also got these escalating tensions with Hezbollah and a lot of back and forwards with, rockets coming into Israel's north, Israel retaliating. There was an incident just the other week where 12 kids were killed by a rocket attack coming from Lebanon, from Hezbollah. So a lot of concern that perhaps, this weekend we may even see some big geopolitical volatility. Do you think that is factoring into investors' minds here?
Yeah,
or just the gold bugs?
No, this is a really good point that you bring up, and if you're an investor and you're an institutional investor and you've got this massive book of positions, and there's a portion of it is in risk assets, then you have as much instability as we're seeing out in the Middle East right now. You're not going to want to have 100% exposure going into the weekend. You never do, because you just never know what's going to happen. That's why you have events that are like Black Monday, because you have things that happen over the course of a week or three or 4 days over a weekend. Long weekends are the worst, but people get a chance to sit back and reflect on what's going on. And that's when they come in on Monday and they rebalance their books and to either take risk off or to avoid risk. And so when you have situations like you've so well described, that is something that's on investors' mind for sure. And on the flip side of that, it absolutely means that gold would be a flight to safety, and that you're seeing that while the markets are starting to sell off in earnest here, gold touched an intraday all-time high today, and so that shows that this is a flight to safety, and investors are concerned on multiple fronts. It's not just inflation, it's not just the jobs number, it's not just the possible serious down trace of the risk assets and Mag 7s and AI fluff coming off the top of the market. There are multiple fronts that investors are concerned about right now, and we have discussed the political environment, and that's been pretty volatile here in the United States for the last number of weeks. I mean, we had a potential assassination of a former president, current candidate for president, and then we had the other candidate step down and hand the reins to somebody who has never even gotten a vote. I mean, so there's... I
don't know about step down, more like forced to step down.
Yeah, it's clear that it was reluctant, right? And so there's tremendous amount of uncertainty coming out of Washington right now, and so that's also weighing on the markets. You saw certain sectors really do well right after the debate. That first debate, then Trump is almost assassinated, and the Trump trade, these sectors like financial sector and healthcare sector and energy sector, they took off while the rest of the market kind of languished. But that's kind of reversed because of this, just the massive amount of uncertainty in the markets right now. And politically, we're just not sure. We don't even know who the ticket for the Democrats is going to be. I mean, we're just a few months out of the election here. We don't even know who's on the ticket. I mean, it's almost insanity.
Right. I mean, it looks like it's Vice President Kamala Harris. We don't know who she's going to pick to be her vice president, but she hasn't officially been, confirmed yet 100% either. So still anything can happen ahead of the Democratic convention.
Even though they're calling her the candidate, the democratic process is to go through the convention and have delegates choose who they want. We haven't had that yet. So it's going to be interesting. I feel like there's another shoe that's going to fall in this election race, and we have not seen it yet.
I don't think you're wrong on that one, James. I think, as I keep on saying, anything is on the bingo card for 2024, and I'm not entirely sure that things are as they're going to appear. And just so we're clear, the delegates at the convention decide based on how the people have voted. You know, they have we've kind of usurped that process for Americans voting in the Democratic primary.
That's right, and they haven't voted for. They haven't issued one vote for Kamala. She's never, So I mean, I think when she dropped out of the race last time, I think she had less than 1% of the votes in the primary. So it's just we're not seeing pure democracy play out. It's gamesmanship out of DC, and that is making investors nervous.
Care to hazard a guess as to what this other shoe to drop could be?
I have no idea. Welcome to 2024.
Or anything is possible. There's been some speculation, Michelle Obama, Hillary Clinton, either as the candidate or as vice presidential candidates, who knows? But I agree that still tremendous volatility on the domestic front, of course, on the geopolitical front. And now we've got more indications that the U.S. economy, contrary to some of the data that we received, I'll remind our viewers that the latest GDP reading was at a relatively robust 2.8%. But contrary to all of that data, things are not looking so peachy keen and rosy. And we've been saying this for the longest time, that there's a major disconnect between what we're seeing in the markets, in Wall Street, and in Main Street in terms of signs of the real economy. And it seems like those two perhaps are starting to come together here. Let's talk about what it means, though, for a portfolio. We've seen that, gold, as we've said, hit a new intraday record high today, and gold has been performing well on this uncertainty. Bitcoin not doing so well, down at about, I think, 62,000 last I checked.
Yeah.
Bitcoin not coming through as a safe haven asset, even though that's the intention there.
Yeah, I mean, let's be clear. Bitcoin has been, for a long time, it's been the tip of the risk spear, right? So it has benefited from risk asset inflation. And so as more money have come into risk assets, it's gone into Bitcoin as well. And Bitcoin being a super volatile asset, it's done well on the volatility to the upside. But remember, Bitcoin has had a tremendous run over this year in particular, because of the injection of capital coming through ETFs, and that's been a great development for Bitcoin. And I believe that it's going to spur more institutional investors to do their homework, learn about the asset, see why it's different, and have a true understanding of it, and then add it to their portfolios in a separate allocation. And that's really the progression that we're looking for here. We're not there yet. It's taking institutions a long time to get comfortable with this asset. However, if you look at this chart, you can see that along the way throughout the last, over the last, I'd say 9-11 months, you can see the orange line shows you where that Bitcoin drawdown has been from the all-time high, whereas where the NASDAQ is, and they're right on top of each other. So Bitcoin did have a drawdown over this last number of weeks, but that has to do a lot with what's been going on in this election. You had a nice run up, tried to get through the all-time highs again. It looked like Trump was going to be like just sweep. It looked like he was going to win a landslide a month ago, and right when he almost got assassinated, you could see Bitcoin jump back up. But then, as this whole thing is played out, Bitcoin has kind of drifted a little bit. But look at where it's come to. So it's right on top of where the NASDAQ is on a drawdown from the all-time high. So this is really interesting. As you look at this chart, you can see that Bitcoin had a very nice run from the creation of those ETFs. It got to that all-time high, but since then it's been consolidating, and this has been healthy to me. It's been super healthy. If you remember, Michelle, The last time we saw Bitcoin actually act as a risk-off asset was when people's money was being threatened. And that was back in the Silicon Valley bank disaster. So
Right.
during that disaster, and when that looked like it was going bankrupt, and it ultimately did, Bitcoin rallied, and Bitcoin did well during that time. And that's because people they woke up and said, oh my gosh, my money is not safe in the bank. Well, of course, the Fed came in and said, yeah, it's safe. Don't worry. We're going to come up with these acronyms for these bailout programs, and your money's going to be safe here. So don't panic about that. So Bitcoin kind of went back to where it is, and people haven't had to learn about it yet. What we're looking for is some sort of disruption in the market that is like that forces Bitcoin to be the risk-off asset. It's not there yet, but I believe as we get more institutions understanding and allocating to it in their portfolios, it will get to a size that it will be a store of value, a true store of value with lower volatility. It's just natural, as it's only a $1 trillion asset right now. If you look at the overall assets in the entire world, the investable assets in the world, you're up at about $900 trillion worth of investable assets. Bitcoin's just a fraction of that. It's like 0.15%. If you get 1% of those investable assets, Bitcoin's going to be trading over $400,000. And so that's the point, is that once it's there and you have $9 trillion, $10 trillion in that asset, it becomes a place where investors can feel comfortable and they can be confident that it's a long-term store of value. And that, Michelle, is when we start seeing allocations out of other asset classes, not just it being allocated as an asset class itself, but allocations out of things like long-term treasuries, for instance, where you're seeing that you're getting negative real rates for long-term bonds. And investors will eventually wake up and say, why am I putting my money in a 20, 30-year treasury that, if you look at inflation, and inflation will be high over the course of the next couple of decades, or at least the next decade, because of the deficits we're running, because of the amount of debt that we have, there's no choice. We have to run negative real rates. That's just reality. We have to debase the currency in order to keep up with it. So you need nominal GDP to go higher because of inflation, which means that inflation is causing your bonds to not be worth as much on their yield, which means that you're getting a negative real yield. And once investors clue into this and those yields are not high enough on those bonds for them to store their value, they will turn to Bitcoin eventually. And when that happens, well, then it becomes a 2, 3, 4, 5% allocation or even more.
You know, you mentioned obviously the Trump trade in the political landscape, and that has a big impact on Bitcoin because Trump has come out as aggressively pro-Bitcoin. He did have a reawakening, a turnaround from a position several years ago, but now he's aggressively pro-Bitcoin. He appeared at the Nashville Bitcoin conference, and there he pledged to make Bitcoin a strategic reserve asset, promising to keep all of the Bitcoin currently held by the US. And the US is actually one of the top holders of Bitcoin because it seized massive amounts of Bitcoin from illicit actors and nefarious activities. The government holds around between 200 and 210,000 Bitcoin, which is, I think, over like 13 billion or more based on today's prices. So obviously that was a huge, huge statement. And then we just had Senator Cynthia Lummis introducing a proposal that could see the Fed holding Bitcoin as a strategic reserve asset, coupled with what we heard from former President Trump. And the move there aims to stabilize the US dollar and provide a hedge against economic instability, similar to how gold is used. The new bill is titled the Boosting Innovation, Technology and Competitiveness Through Optimized Investment Nationwide Act of 2024, shorthand Bitcoin Act of 2024. I love it how they make the acronym, work with other words. It's always quite clever. But this is
lots of interns working on those acronyms.
Lots of interns indeed, right? That's according to a draft of the bill. So it creates this Bitcoin purchase program that'll buy, 200,000 Bitcoin per year over a 5-year period. Again, that doesn't take into account the reserves of Bitcoin that the US already has. Firstly, let's just talk about how significant it is that this is a conversation that's being potentially had by senators of the United States and presidential candidates from RFK to former President Trump, taking Bitcoin as a major political issue. And then we'll circle back to the likelihood of this bill actually being passed. But pretty significant that we've come such a long way.
No, it's massively significant. I mean, we'll be clear. There's a lot of political rhetoric, and politicians will use this as a talking point to get votes. They know that the studies have shown that there are about 50 million people in America who own crypto, Bitcoin being easily the largest share of that. And so they're trying to get those votes. And so they're going to give these sound bites. Look, Cynthia Lummis, Senator Lummis has been, or Lummis, sorry, has been, Lummis rhymes with hummus, I think. So Cynthia Lummis has been a champion of Bitcoin for the last year plus, and she's been out there just pounding the pavement, trying to get some regulation around it. That's positive regulation, and trying to be sure that Bitcoin can be something that the U.S. can turn to as a real store of value, and so the citizens. And so she's been a champion of that. But the political rhetoric, I mean, we saw it in full form out in the Bitcoin conference in Nashville last week. You know, Trump had a campaign stop there. Essentially, he got up on stage and he, pounded the microphone and said, "Look, I'm your Bitcoin guy." But in the speech, you could tell he doesn't really understand Bitcoin fully. That's okay. I think it's ultimately a positive. It's a net positive that it's forcing the conversation. The politicians are talking about it. RFK Jr., he does understand it. He has Bitcoin. He owns it. He's spoken about it for a long time. He's spoken with many people in the industry about it. We talked to him about it last year. A group of us talked to him about it at the Bitcoin conference in Miami. He's well aware of Bitcoin and the advantages of it. But the legislation around it, getting it done, that's a whole nother conversation. So, Senator Lummis has been doing this, and she's been roadblocked by the White House, by Elizabeth Warren, but she's working and she's forcing the conversation. She's having the conversations on the Senate floor with the other senators, and this is really important. It's not something that's just going to go away. I think the significance of BlackRock and Fidelity being so involved in this asset class now can't be understated. And it's forcing all of these politicians to wake up and say, this is real. It's not going away. We either have to try to kill it, which is Elizabeth Warren's position, or we have to find a way that we can be friendly with it and work with it so we can benefit from it too, which is Senator Lummis's position, and that's really important. So it's not going away. This is in the conversation, and I think that it's a huge positive.
Let's bring this back to your overall macro outlook, where big picture, you say all roads lead to more money printing and more liquidity, not only from where we are in the near term with a potential recession, but also big picture, as we've discussed many times, this endless doom debt spiral. Give us a recap of your thoughts on that and where Bitcoin and gold fit in.
I mean, we just crossed, Michelle, $35 trillion of national debt. I mean, it is a dubious honor for us. We just keep piling more and more and more and more and more debt on the bill. Those massive deficits they're forcing this to grow exponentially. And so what we have what we have is $35 trillion of debt, and something that nobody talks about, well, a few people talk about, is $215 trillion of unfunded liabilities, the vast majority of that in Social Security, Medicare, and Medicaid. And so this is the ultimate Ponzi scheme now, because by the time I retire, that fund is depleted. And so I might get 60 or 70 cents on the dollar as it stands now. The only way that can be avoided is by either raising the taxes on future pay-ins or cutting my benefits. That's the only way we can reconcile this. The only third way we can do it is just print more money and ensure that there's tons of inflation and somehow fill that gap with another program, another acronym. I'm sure that they'll have interns dreaming this up for years. So, but the reality is there's going to be more printing because if you're a politician, you want to get reelected. And it's political suicide to cut benefits. So they're not going to do that. Neither party will do that. So it means that they've got to fill that hole somehow. And that's a massive hole. We're talking about $250, $260 trillion of total debt that this country, that we don't have the money to pay for. If you add all this up, it's kind of like somebody who's got $100,000 salary, but over $5 million of debt. It doesn't add up. You're essentially bankrupt.
But it's not just that even in the long term, James, because we talk about, the Fed stepping in and acting here and cutting rates. We're not even so convinced that, inflation, assuming we take the government figures at face value, is under control. We've still got this massive idea of the dollar purchasing power being severely eroded and debased and devalued.
Yeah, I mean, it's a good point. My thesis on this is that there is no way that we can get through this period of the next 10 or 20 years of super low inflation. We have to have inflation. If we do have an AI productivity miracle, it's not coming in the next 2 to 5 years. It might come 5, 7, 10 years, and that will help. But when you're spending money and you're not creating real productivity, it's a problem. We could have used trillions of those dollars and built nuclear power plants across the country and had an energy boom here, but we didn't do that. We've been spending money on green energy that has shown to be problematic at best. And even with all the subsidies, it's not profitable. So that's been a problem. You need real productivity. And so we could see an AI productivity miracle, and that could help. But on the flip side of that, we need spending to get GDP higher to pay down this debt somehow, because it's just growing out of control. So when you get to the point of where we are today, where we're spending more money on interest per year, over $1 trillion on interest per year, than we are even on our military, which is about $850 billion that we know of, that's just insanity. And so you have to fill that gap with something. And that something is monetizing the debt, especially if we see a downturn here. There's no way around it. We're going to have to print money unless we want to go into a period of massive turmoil and a total reset of our economy. And that would be, I think, too painful for any politician and to allow the Fed to really do.
So given this, as we wrap up here, James, how are you structuring your portfolio in light of what you're seeing happening?
Well, that I am managing a Bitcoin focused hedge fund. And so I am tremendously optimistic about Bitcoin and the ecosystem and the businesses that will be built around it. I think when we turn around and enter a period of enhanced liquidity in the markets, Bitcoin is going to benefit from that greatly. I think it will be the leading asset to benefit from that in truth. And so I'm super optimistic about that space. That is the bulk of where my time and my exposure is in that space. I do own some gold because, I'm an old investor. I've been doing this for a very, very long time. And I think that it's a worthy asset to take some risk off the table and to balance your portfolio, especially when you do have all of these volatile periods in Bitcoin. Now, we don't do that in my fund. My fund is it's on a Bitcoin standard where our treasury is in Bitcoin. But personally, I do have some gold. Personally, I've taken risk off the Mag 7 and the market, and the only cash that I hold is in T-bills. because we're still getting a good rate there, and there's no interest rate risk on that. So if the interest rates come down, it's not going to affect me. It just gives me cash to be ready to pounce on opportunities that may show up in the market.
So do you have any gold price forecast that you have in mind?
A price forecast, I would have to defer to your gold experts on that, but okay. I do expect it to be up at least 20% in the face of this next year. I just can't see it not being that ultimate store value and benefiting from both the flight to safety and excess liquidity.
So potential 20% upside from gold here, but we will confirm with our gold experts. But seeing as you're the Bitcoin expert, you walked right into this, James. What is your Bitcoin price forecast? Maybe end of 2024, maybe mid 2025. On a more short-term level, how do you see Bitcoin performing?
I still see Bitcoin reaching $100,000 this year. It's going to consolidate. It's been consolidating for months here, and even if we have a short-term liquidity dump, I do see Bitcoin benefiting from the turnaround in these markets that we will have, and I believe that's going to be over $100,000 this year. I could see it reaching into the mid to high hundreds in this next 18 months.
Irrespective of who wins the elections, you still think Bitcoin hits 100,000 by end of 2024? I
do.
All right. Well, we will have you back on when we get closer to see how that situation develops. James, for our viewers that want to learn more about you and The Informationist, which I believe is now approaching 40,000 subscribers. As I say, I look forward to it every weekend. Tell us where they can find more James Lavish.
Yeah, you can just you can find the newsletter on jameslavish.com, and you can find me on Twitter. I'm just James Lavish on Twitter, and I write about all this stuff. So the fund itself is closed. We're not accepting new investors, but we as we see more opportunities and more liquidity comes into this space, I am certain there's going to be it's going to warrant us having to open another fund to take advantage of those opportunities from our current investors and more investors. So anybody who's an accredited investor can contact us on that, but that's where we stand.
All right, James, thank you so much for sharing your insights with us, especially on a Friday afternoon in the summer. Thank you again, James Lavish. Appreciate it.
Thank you for having me, Michelle, and I look forward to the next time.
As do I. Thank you again to you, our viewers, for watching. And I'd also like to take this opportunity to mention our sponsor, Swan Bitcoin. I want to highlight the Swan IRA product, which allows you to take advantage of Bitcoin's potential long-term potential, the benefits there, in a tax-advantaged account. With a Swan IRA, you can hold real Bitcoin, not proxies. And opening a Swan Bitcoin IRA is very simple. You can initiate a transfer or a rollover and hold real Bitcoin in your new IRA. And there's a way to set it up that you're basically buying Bitcoin on autopilot. So that allows you to take advantage of dollar cost averaging, the volatility in the price of Bitcoin as you accumulate Bitcoin into your IRA. And unlike when you trade Bitcoin outside a tax-advantaged account, doing so with an IRA does allow you to avoid the very tedious process of reporting trades on your taxes every year. So for those interested, there is a link in the description with a special offer for Kitco viewers to help facilitate that process. Make sure to take a look at that. Check that out. As always, thank you so much for checking us out. For me, Michelle Makori, and the rest of the team, we'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.